Right, U.S. President Donald Trump's tariff threats continue. This time, he wants to impose tariffs of 25% on automobile, semiconductor, and pharmaceutical imports.
It'll be 25% and higher, and it'll go very substantially higher over a course of a year.
For decades, commerce between Canada and the United States was an example of perfect familiarity. From car components to aluminum, forest goods to dairy, practically everything crossed the border every day, and the tie between the two countries was thought to be unbreakable. Now, President Donald Trump's harsh and unexpected tariffs are prompting widespread concern in Canada. On the one hand, he threatens to put severe penalties on industries such as oil, steel, aluminum, and agriculture. On the other, he has already attempted to do so multiple times. Nonetheless, Canada is pushing back, stating that it will not capitulate. This country, which sells up to 4 million barrels of crude oil per day to the United States and is the country's top supplier, is presently seeking other sources. At this point, the issue of whether Canada would prefer China or the European Union over the United States does not appear ludicrous. With the inauguration of pipeline projects like Trans Mountain, news that tankers departing from Vancouver's port are traveling to markets such as China and Japan has sparked concern in Washington. There is widespread speculation that if Trump's trade threats persist, Canada will rapidly adopt what he refers to as the third option. But what will this change? Canada's oil exports, which rely significantly on the United States, are currently at a strategic crossroads. The country, which has historically exported 90% of its daily oil flow to the United States to supply its refineries, now has access to the Pacific coast thanks to the development of the Trans Mountain pipeline. Tankers may now transport crude oil delivered by the pipeline across the ocean to refineries in China and other Asian countries. Indeed, a few years ago, such a scenario would not have been regarded seriously because there was no clear alternative to America's market edge and logistical simplicity. According to data from the China Institute, 50% of all oil shipments through Vancouver are delivered straight to China. This is a photo that begs the United States, "Are you prepared to lose me?" Furthermore, given Trump's tariff bluster, Canadian crude oil may become more expensive and enticing to Chinese refiners than American refiners. That is why Ottawa is warning, if you put in unilateral pressure, we will strike new oil deals with China. Many observers in the United States believe Trump's tariffs will cause issues for the country as well. Protectionism may appear to safeguard business on paper, but in fact it disrupts supply networks and causes consumers to pay more for their products. Furthermore, greater costs for Canadian oil or metals may undermine U.S. refineries in the worldwide market. A large consumer market, such as China, would be delighted to buy oil from Canada, refine it in its own refineries, and sell it on the global market. This is how the trading logic works. If one party closes doors or raises prices needlessly, the other side seeks other solutions. Consider Canada's Trans Mountain pipeline. And this is only the start of what might be a larger strategic shift for Canada. Canada's reconciliation with China might pave the way for larger oil agreements. It reflects what used to be known as the third option, a strategy for breaking free from American hegemony and strengthening ties with other trading partners. There was a comparable issue in Canada 50 years ago. At the time, the so-called third option strategy sought to reduce Canada's overdependence on the United States. This dispute is resurfacing now, fueled by Trump's rhetoric. What are we planning to do? According to certain voices within the country, we are overly reliant on the United States, and even little trade tensions cause us headaches. This time, China is not the sole choice. The European Union is also considered. The Comprehensive Economic and Trade Agreement, or CETA, has already pushed tariffs between Canada and the European Union close to zero. Yes, the geographical distance is a significant obstacle, but Canada's position is clear. At the very least, we can overcome the challenges and devise new means to transport oil to the European Union or Asia, giving us more options. This offers Canada an advantage at the trading table. Think about it. The United States imports almost half of its crude oil from Canada, the majority of which is heavy crude. If Trump wants to drag Canada to its knees with tariffs, Canada might respond that there are alternative purchasers for its oil. Among those buyers, China appears to be the most dominant. We've even read that Canadian oil will open up new chances for China. This implies that if U.S. refineries are forced to pay a higher price for Canadian crude oil, they will lose competitiveness. Chinese refineries can earn better pricing and grow their share of the global oil market. Canada, in turn, could avoid the unpredictable tariffs imposed by the United States and retain a massive market like China. Many analysts in Washington believe that Trump's agenda might backfire. The fact that the two sides are at such a critical juncture is infuriating Ottawa MPs, who argue that Canada is not a meek nation. Trump's threats are viewed not merely as an economic issue, but also as an attack on 40 years of friendly relations. Some people are protesting, even booing, the United States national anthem during sporting events. In this environment, Canada feels compelled to take strong action. Not only Trans Mountain, but maybe Energy East or Northern Gateway as well. Despite challenges such as opposition from environmental groups, complaints from indigenous tribes, and state-federal tensions, the prospect of building more pipelines is being discussed, with the justification that Trump forces us to do so. Maybe there won't be a full revolution, but there is a real conversation in Canada about the need for increased coastline access to Asia, including more tankers. Of course, all of these initiatives are on the table, but it is evident that they will not be easily implemented. Global oil markets remain unpredictable, the economy is weakening, environmental opposition is strong, and logistical expenses are high, but Canada may pay a significant price for being tied to the United States. While the two countries' long-standing relations cannot be severed so quickly, their growing moves to open up are eroding America's negotiating power. This is precisely where the issue arises. What would Trump do comes to the forefront. Although the President of the United States has temporarily postponed the tariffs, he has stated that he would find fresh excuses to reinstate them. Because of this uncertainty, Canada has devised a backup plan to avoid being caught off guard. It appears that the Canada-China oil agreement might enrage Donald Trump, and this possibility is not far-fetched. As a result of all of this, the issue of whether Canada and the United States' most important economic tie will ever be tested is being raised. Explosions in projects such as Trans Mountain and ships moving from Vancouver to China demonstrate this. However, the United States has a physical and logistical edge, and it may continue to be the most profitable market for much of Canada. Perhaps this is simply a show-the-stick strategy. Canada hopes to compel Trump to back down by stating that options from the European Union and China are on the table. Consumers in the United States may push the government not to raise fuel or product prices in response to tariffs. Who knows? Perhaps both parties will make sacrifices and reach a win-win solution. A trade war may impact not only Canada and the United States, but also global oil markets and European and Asian refineries. The globe is once again rocked by a trade conflict between big countries. Perhaps at the conclusion of 30 days, Trump will announce tariffs, and Canada will announce that it is signing a large oil agreement with China. When that day arrives, the fires of the trade war will most likely consume both countries' economies. However, some observers predict they will reach an agreement before the hotspot arrives. Nonetheless, this uncertainty fuels market fear. What are your thoughts? Can Canada sell big volumes of oil to China or the European Union instead of the U.S.? Will geographical and political realities prohibit it? Will Trump's tariffs actually result in a painless outcome for the United States? Or will losing Canada be far more costly? It is an open agenda, and the world is watching with bated breath. Please share your thoughts with us. And don't forget to subscribe and enable alerts. How this bizarre energy chess game is handled will influence not just the fate of the two countries, but also the global trade balance. Goodbye.